Good afternoon, traders. The S&P 500 closed above 7,000 today, and yet for the second week running, our entry gate said, hold. Welcome to the VIXShield Daily Market Summary. Market Close Recap for Thursday, April 16th, 2026. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution. Signals only. Past performance is not indicative of future results. Today we walk through what the market actually did, why volatility behaved the way it did, and what our signals told us, and just as importantly, what they told us not to do. This is the story of discipline in action. Let's start with the numbers. The S&P 500 closed today at 7,041, a gain of roughly 0.25% on the session. Not dramatic, but notable, because crossing and holding above 7,000 is not a trivial thing. It tells you something about where institutional conviction currently sits. The CBOE Volatility Index, known as the VIX, settled at 17.84. Yesterday it was sitting at 19.23. That's a drop of roughly 1.39 points, or about 7.2% in a single session. When the VIX falls that sharply in one day, while the S&P holds its ground above a round number, the market is sending a message. Fear is receding. And context matters here. The VIX's 5-day moving average sits at 18.53. Today's reading of 17.84 is about 3.7% below that average. When spot VIX falls below its own short-term average, that is a favorable signal for options premium sellers. The trend is moving in the right direction. Now, the term structure. The VIX measures near-term implied volatility, roughly the next 30 days. But there's another measure called the VXV, which captures the market's expectation for volatility over the next 3 months. Today, the VXV sits at 20.67. That means longer-dated volatility is priced about 2.83 points higher than near-term volatility. That relationship, where the curve slopes upward from short-term to long-term, is called contango, and contango is the normal, healthy state of volatility markets. It simply means the market expects things to stay relatively calm in the near term, with modest uncertainty further out. For income traders who sell options premium, contango is your friend. Beyond equities, the broader market picture today was interesting. The US dollar index dipped modestly, down about 0.16%. That kind of mild dollar softness tends to be supportive of risk assets, as it eases pressure on multinational earnings and emerging markets alike. Meanwhile, in the crypto space, Bitcoin surged more than 6.5% on the session, and Ethereum climbed better than 7.5%. When crypto moves that aggressively to the upside, while equities grind calmly higher, that's a risk-on signal. Investors reaching further out the risk curve in search of return. Gold added 1.5%, which adds a nuance. Some safe haven demand remains. But the headline in cross-asset markets today was crude oil, which fell sharply, down more than 9%. A drop of that magnitude in crude speaks to demand concerns, and it's worth watching. Now the headlines that shaped today's session. The most striking story of the day came from Investopedia, whose headline read, "The stock market recovery has been dramatic and fast." The subheading, "War is over until further notice." That framing captures the mood precisely. After weeks of tariff-driven turbulence and geopolitical tension, markets appear to have exhaled. Investors are pricing in a period of relative calm, at least for now, and that exhale is reflected directly in the VIX's sharp single-day decline. And behind that headline sits another one, from Schaefer's Investment Research. noting that while the S&P 500 and the Nasdaq stayed, quote, red hot, the Dow cooled off. That divergence matters. It suggests the rally is being led by technology and growth names rather than broad industrial participation. When the leadership is narrow, experienced traders watch carefully. Narrow rallies can be durable, but they can also reverse quickly if the leading sector stumbles. Which brings us to the Seeking Alpha piece, whose headline was blunt: "This rally won't end well." Now, we don't editorialize on individual analyst opinions here, but the existence of that headline tells you something important. There is a meaningful contingent of sophisticated market participants who remain skeptical of this move. That skepticism is healthy. It's part of what keeps volatility from collapsing entirely. Meanwhile, from markets media, CBOE, the exchange that operates the VIX, reported record daily volume in its proprietary index options. Record volume in index options means more participants, more hedging activity, more premium changing hands. That is the ecosystem in which our strategy operates, and a more liquid market generally means tighter spreads and better execution conditions. Taken together, today's headlines told the story of a market that is simultaneously relieved and uncertain. The acute fear has faded. The VIX confirms that. But underneath the surface, smart money is hedging, volume is surging, and not everyone believes this move has legs. That tension is exactly the kind of environment where disciplined, rules-based trading earns its keep. Now let's look beneath the surface at volatility. The VIX at 17.84 is declining, and meaningfully so. As I mentioned, it sits 3.7% below its 5-day moving average. In our framework, a VIX trending below its short-term average is a bullish signal for premium sellers. The direction of travel is favorable. The term structure, as we discussed, is in contango, spread of 2.83 points between near-term and 3-month implied volatility. That's a normal, healthy structure. It means the volatility futures market is in carry. Longer-dated contracts are priced higher, which is the natural resting state when markets are not in crisis. Now, the 10-day historical volatility, what we call HV10, came in at 12.01%. This is a measure of how much the market has actually moved over the past 10 trading days, as opposed to what the options market implies it might move. The VIX at 17.84 implies more volatility than the market has actually been delivering. That gap between implied and realized volatility is the fundamental engine of options premium selling. When implied volatility runs above realized volatility, sellers of premium have a structural edge. And then there's our expected daily range indicator, the EDR. Today, the EDR came in at 1.38%. Our entry gate requires the EDR to be below 1.5%, so the EDR gate was met. The S&P is moving in a contained, measured way. That part of the picture is clean. Now, the strategy insight for today. The EDR gate was met. The term structure is healthy. The VIX is declining. So why are we holding? Because of a single, non-negotiable rule. Our place signal requires the VIX to be below 15. Today, the VIX closed at 17.84. That is above the threshold, and when one gate fails, the answer is always the same: hold. This is day 7 of consecutive hold signals. 7 sessions in a row where the system has said, not yet. And I want to sit with that for a moment because it's easy to feel like holding is passive. It isn't. Holding is an active decision. Every hold day that avoids a losing trade is capital preserved, and preserved capital is the foundation of every future trade. Now, as an educational exercise, let's look at what the iron Condor structure would have looked like today had conditions been met. This is not a trade recommendation, This is the methodology in action for learning purposes. The conservative tier would have evaluated strikes at 68, 95, and 6900 on the put side, and 7180 and 7185 on the call side. Net credit, 65 cents per contract. Maximum loss, $435. Risk to reward ratio, 6.7 to 1. The balanced tier would have looked at 69, 25, and 69.30 puts, with 71.50 and 71.55 calls. Net credit, $1.10. Maximum loss, $390. Risk to reward, 3.5 to 1. The aggressive tier, 69.55 and 69.60 puts, 71.25 and 71.30 calls. Net credit, $1.55. Maximum loss, $345. Risk to reward, 2.2 to 1. These structures tell you what the market is offering right now. They're attractive, but the gate is the gate. What to watch for? The VIX needs to close below 15 before we evaluate a place signal. We're not far, but we're not there yet. One more note, our theta time shift analysis is in forward roll mode today, meaning if positions are already open, the data supports extending duration to 7 days to expiration to capture additional vega. The EDR temporal reading of 8.02% is well above the threshold of 0.94%, and the VIX above 16 supports the extension. Estimated vega capture in that scenario, 45 to 80 cents per contract. Our ALVH protection framework, the hedge overlay, has 2 of its 3 layers currently active. The short-term spike guard and the medium-term wave shield are both running. The long-term endurance hedge is inactive under current conditions, which is appropriate given the contango environment. And that brings us to the discipline lesson for today. 7 consecutive hold days, in a market that is moving higher, where the VIX is falling, where headlines are turning optimistic. This is precisely when discipline is hardest and most necessary. The temptation to override a rule because conditions feel good is the most common source of avoidable losses in options trading. Feelings are not a gate, rules are. The VIX entry gate exists because below 15, the market has historically demonstrated the low volatility, range-bound behavior that allows iron condors to work as designed. Above 15, even if the trend is favorable, there is enough residual volatility risk to justify patience. The system is not being conservative for its own sake. It is being conservative because the data supports it. Looking ahead to tomorrow, watch the VIX closely at the open. A continuation of today's decline, particularly if we see a close approaching the 15 to 16 range, would begin to narrow the gap toward a potential place signal. Also watch crude oil. A 9% single-day drop in energy prices has macro implications that may ripple into equity sentiment by Friday's session. And keep an eye on whether crypto's risk-on surge today carries into tomorrow or fades. That will tell you something about the durability of today's appetite for risk. If you found today's summary valuable, share it with a friend. Both of you will receive 14 extra days of free trial access to the full VIXShield podcast and signals. Your personal share link is waiting for you in your member dashboard. This market summary is brought to you by VIXShield, your protection against daily uncertainty. Thank you for spending part of your afternoon with us. We are here every market day at 3:05 Central. Trade with discipline. Protect your capital. We'll see you tomorrow. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution. Signals only. Past performance is not indicative of future results. Today is a hold day. The VIX entry gate was not met. the VIX at 17.84 remains above the required